Let's bring in now JPMorgan Asset Management Chief Global Strategist David Kelly. David, great to have you with us. What's your take on that move we've seen in the 2-year? Do you think it's a bit ahead of the skis in terms of how many cuts we might get?
Not really. I mean, I do accept the point that on a Friday after 4th of July, don't necessarily trust what's going on in terms of trading. But overall, we think that things are setting up for 2 cuts this year, one in September, one in December. What we're seeing is the economy is cooling, but it's cooling slowly. That's very much the theme in this jobs report. I sort of echo what Steve was saying about it. I think it's significant they downgraded payroll job growth by 111,000 for the prior 2 months, and also that drop in temporary workers. These are signs that the economy is just gradually decelerating here. And we're also seeing signs that, despite a tight labor market, it's still tight with an unemployment rate of 4.1%, we're not seeing wage growth come out of that. So next big headline will be next week's CPI report. We think we're going to be down to a 3.2% year-over-year number. And that should push the personal consumption deflator down from 2.6 to 2.5 year-over-year. So we're edging ever closer to that Fed's 2% target. And I think that's enough progress for the Fed to begin to cut in September.
How much does where those yields are sitting influence whether you should be increasing or decreasing your exposure to U.S. equities?
Well, I think this is a time we've got to be pretty careful here because valuations are high. We've had a huge rally last year and this year, and obviously mega cap valuations are distorting everything. But overall, these markets are high. And sooner or later, we're going to have a significant correction. And what I know about previous corrections is when you're in a correction, you don't want to be in the most expensive stuff. So I think people do need to be careful here, not because of anything that's going on in the economy. The economy, in fact, in some ways, the economy is building sort of bubbles in markets because it is so steady. But we have seen this continued move upwards in equity prices. I think it's a time when people need to be very careful about diversifying their exposure and not being overexposed to the most expensive names.
I know you've spoken in the past about the risk of concentration in the current environment. Do you expect there's also a group think that the broadening out will be receptive from the broader market as well? Do you expect to see more breadth in the market in the months to come?
Yeah, well usually the market gains breadth when it loses height. And so I am concerned that, yes, the market could get a good deal more breadth, but I think that concentration will diminish. But I think there is an increasing risk that concentration will diminish because the market takes a tumble and the stuff at the top takes the biggest tumble. I'm not, people need to be long-term investors. I'm a long-term investor. I don't think it's a time to pile into cash, but I do think it's a good time to think carefully about the valuations of the stuff that you hold in your portfolio and ask, yes, the market's concentrated. How concentrated are you? Are you, by leaving everything set, so to speak, over the last year or two, are you now in a position where you've got more risk than you really should have in your portfolio?
Yeah, although people would say, you can't help but be concentrated in a sense. Even if you own the S&P, you're really, 30+% is 6-7 stocks, David. That said, those who are favorable on those stocks would point out, the multiples are high, but they're not overly high, certainly compared to other periods of perhaps what we could call excess.
Well, yeah, but we've had extraordinary earnings out of these companies, and a multiple should be based on earnings that are going to come for years and decades into the future. And the real question is, particularly in the technology space, are you sure that this company can build a ring fence around its cash flows going forward, so it's going to be able to maintain these margins going forward? Because if there's a crack, and if someone's going to compete that away, then these stocks are not worth these multiples. And it's a different story for each company. So you do have to look at it company by company. But I get nervous when you've got multiples this high because it does depend on a long string of future years of great earnings to really justify that multiple.